All right. Hi, everyone. Welcome. Thanks for joining us today for our Australian property market update. I'm Andrew Grinsell, the Head of Wealth here at Cooee Wealth Partners, and I'm looking forward to running you through this update today. Look, there's been no shortage of headlines recently about the property market, some of them optimistic, others a little more dramatic. But look, really today is all about moving beyond the noise and giving you a clear picture of and practical view of what's really happening and what that means for you. We'll have a look at different parts of the market and how they've been performing. We'll have a look at what's driving prices and what the next few years might look like, and how really some smart planning around timing, tax, and strategy can definitely make the difference. So whether or not you own property already, or you're thinking about investing, or you just want to understand where things are heading, this decision is designed to give you some insight that you can actually use. Now, if anyone's having any problems viewing the slides or anything, just let me know. But so far, so good. Thank you. All right, before we begin, just a quick reminder, the information shared today is for general information purposes only and should not be considered as personalised financial advice. So we recommend that you consult one of our wealth partners who can take you through your individual circumstances and take that into account before making any investment or other financial decisions. And as always, past performance is not indicative of future results, and all investments carry inherent risks, including the potential loss of capital. Now, I do have Q&A enabled for today's meeting. So in Microsoft Teams, you should be able to click on the Q&A button. So if you have any questions as we're going through, please just pop them in. I'll get to them at the end. So yeah, just jump in, use the Q&A or use the chat, and we'll cover that off at the end. All right, so before we get into the details, let's have a quick look at what we'll be covering today. We'll start with a recap of recent property market performance. We'll have a look at what's been happening across the different cities and regions and why the numbers might sort of surprise you a little bit compared to what we see in the media. Typically, the headlines don't tell the full picture. We'll then move into the key drivers of property prices. We'll look at things like interest rates, migration, some construction challenges, and how they're shaping the price outlook. Then from there, we'll look at forecasts for growth across the capital cities and regions, unpack some of the housing affordability policies being discussed ahead of the upcoming federal election, and we'll finish off with a few financial planning strategies that involve property. Just things like including timing the sale of property for tax efficiency, deciding whether or not to keep the former home when people upgrade, and also just making the most out of super contributions to reduce tax on capital gains. I've also left a little bit of time at the end for questions, so feel free to jot anything down, and we'll go through it at the end. All right, so before we get into what the market's doing right now, I just want to zoom out for a moment and give it a bit of context, because understanding the role that property plays within our financial system really does help explain why it's such a big deal in Australia. So as at the end of March, Australian residential property is valued at a bit over $11.2 trillion, and it makes up around about 56% of household wealth. Now, to put that into perspective, in most developed countries like the United States, UK, Canada, property makes up more like 30 to 40% of household wealth. So in Australia, Australia is right at the top when it comes to how much of our wealth is tied up in bricks and mortar. We've got over 11 million dwellings, and there's about $2.4 trillion in mortgage debt in Australia. But the net equity we hold in properties is still quite substantial. So look, whether it's your home, an investment property, or both, property is not just a roof over your head, it's also central to how Australians build and store wealth. And that's why making smart, well-timed decisions around property, whether to buy, sell, hold, restructure, can have such a big impact over time. All right, on to slide 5. So let's look now at how different markets are performing across the country as of the end of March. Nationally, dwelling values rose 0.4% in March and are up 3.4% over the last 12 months. So whilst the start of the year might have been a little bit subdued, the broader market has remained resilient. Now, if we zoom in on Sydney, which I know is home for most of you who I can see are on the meeting today, it's had a 0.3% rise in March and is up 0.9% over the past year. So, look, it's not huge growth, but considering how stretched affordability is in Sydney, it's still a fairly steady result. Now, the median Sydney property value is just sitting under $1.2 million. When we include rental income, add that to the growth rate, we end up with a total return over the year at 3.9% for Sydney. Now, just a quick note, total return is capital growth plus rental income, just gives us a better understanding or a full picture for anyone holding an investment property. Now, if we take a look around the country, Adelaide and Perth are the standouts. Both are up 11% over the last 12 months, and their total returns are even stronger thanks to really strong rental yields. Brisbane's also done fairly well, up 8.6% for the year. Melbourne and Hobart are slightly negative over the year, but Melbourne's recent monthly gains suggest that maybe a bit of momentum is starting to return there. Now, interestingly, the regional markets are once again outperforming the capital cities. They're up 5.3% over the year compared to 2.8% for the capital cities. So, look, that's something we'll come back to when we look at the forecasts and opportunities as well. Slide 6. Look, this is a good one to, it gives us a chance to zoom out and have a look at the market with a bit of perspective. On the right, we've got the change in dwelling values from peak. Now, over the last 5 years and 10 years, the data's there, and that's across both capital cities and regional markets. Now, what I find really interesting with this one is that the combined regional markets have actually outperformed the capitals over both the 5 and 10-year periods. So regional areas are up 57% over 5 years and nearly 87% over 10. That compares to 34 and 63% for the capitals. So regional markets have been really strong for the last 5 and 10 years. On the left side, on the bottom, you can also see the rolling 3-month change in value. What we can see there is that the regional markets have consistently kept pace, or in some cases actually outperformed the capital cities, even in more recent periods. Which it's interesting because there's often this perception that capital cities are safer or always deliver stronger returns, but what this data is actually showing us is that the regional markets have been just as resilient, if not more so, especially over the longer term, and also provided better returns. Now, many of our clients, particularly those looking for value and long-term growth, have invested in places like regional New South Wales, Brisbane, and Queensland. Those decisions weren't just made on short-term trends. This was driven by affordability, stronger rental yields, and creating cash flow flexibility so that they could pursue other strategies. So if you've got a property with stronger cash flow than one that might not have decent cash flow, that extra cash flow can do other things for you in a financial planning sense around, being able to put more money into super or pay off mortgages faster or put it into other investments as well. All right, I want to have a chat now about interest rates and borrowing power because we are at the start of an interest rate cutting cycle. So this infographic, it really helps explain how interest rates affect what people can borrow. And look, I find it's pretty eye-opening. Let's say we've got someone who has a budget of $3,000 a month for loan repayments. Now, at a 6% interest rate, that person can only afford $3,000 a month in loan repayments. They can borrow about $465,000. Now, if interest rates come down to 4%, that $3,000 is enough now to actually look after a $568,000 loan. And if interest rates were just at 2%, like we saw a few years ago, that same person can borrow $700,000. So what we see here is that even though they're paying the same amount in repayments every month, the amount they can borrow changes a lot depending on interest rates. Why? That's because when the rates are lower, less of the repayment goes towards interest, so more can go towards paying off the actual loan. And this is why even small changes in interest rates can have a big impact on what people can afford to spend on a property, which then flows into property prices. So with rates expected to gradually fall over the next year or two, we may see borrowing capacity slightly improve, which is likely to help support demand for properties. Now, we do need to factor in that borrowing power is still relatively constrained because we've only had one cut after a very sharp interest rate hiking cycle. But a big question is, well, where are interest rates actually headed to from here? So the RBA made its first move in February with a small cut, and until recently, the broad expectations across the market was for 1 to 2 more rate cuts this year, with further rate cuts into 2026. But I will just point out that in the last few weeks, this has started to shift a little. The Trump presidency, proposed tariff policies, it's creating a bit more uncertainty in global markets. The markets and economists are now increasingly pricing in a faster path to rate cuts in Australia. Central banks might be forced to act sooner to support slowing global growth and also to manage currency pressures. But that's a changing proposition almost sort of day by day. It's incredibly volatile, the interest rate expectations at the moment. I don't know if anyone's looked at the share market today. We've had massive rises off the back of news overnight with Trump suspending or bringing the tariffs down to 10% for at least 90 days for everyone except for China. That then changes the picture. So it's a very fast moving space. However, if we just come back to what the middle sort of forecast is, we're still looking at the cash rate getting down to around about 3.6% by the end of 2026. So it's still a long way from the ultra low interest rates that we had back in 2020 and 2021, but it's a lot more comfortable than the current rate of 4.35%. So look, the other point to just be aware of here is the RBA has been very clear that any moves they make will be gradual and will be data driven, particularly when we have services inflation and wages growth still does remain sticky. So look, for property, what does it mean? It's likely a gradual return of confidence, especially in more affordable markets or those areas with strong rental yield where each rate cut improves borrowing capacity just a little bit more. And for homeowners and investors, this environment opens up the opportunity to revisit existing loan structures, consider refinancing, or even to look at strategically using equity whilst rates start to trend down. We've seen a lot of people sort of get stuck in a situation where they can't refinance their loans to better rates just because of the assessment rates being so high with interest rates being up. But as those interest rates come down, we should start to have a bit more freedom and flexibility for people to shop around with their loans. All right, so the next driver of the property market, and really one of the key ones, is population growth, especially net overseas migration. So if we go back to financial year 2023, Australia saw a huge migration surge, 518,000 people. That's when we take the short-term and the permanent arrivals into account. So adding the light blue and the dark blue together on that chart on the left side. Now that was well above Treasury's forecast of 400,000. It's 118,000 extra people. That spike in demand caught the housing market off guard, particularly on the rental side. Now, most new arrivals, they settle in Sydney, Melbourne, Southeast Queensland, which explains a lot of the upward pressure we've seen both in rents and entry-level property prices in those areas. Now, looking forward, the government is trying to manage this growth more carefully. Migration is forecast to drop back to around 261,000 people by FY 2026. But even that level will continue to see demand outpace housing supply, at least in the short term. So the big picture here is that population growth creates sustained demand for housing, whether that is to rent or to buy. And then when we combine that with delays in new housing construction, especially due to labour shortages and high build costs, it's clear why upward price pressure, is likely to persist at least in the medium term. So for investors, it also highlights the importance of location selections. Areas where demand is growing but supply remains tight can make a big difference to long-term returns. All right, so on to slide 10. We've had a bit of a chat about how population growth is driving demand, but now let's look at the other side of the equation, which is supply. The short version of it is we're not building homes fast enough to keep up. So while building approvals have started to recover, that doesn't translate directly into new homes straight away. Right now, the average time to build a house is about 3.5 quarters. That's a bit over 9 months now, so 10 months. That's 50% longer than it took before COVID. Why? Well, look, there's a few reasons. Construction costs are high, up around 35% since the start of 2020. Labour shortages, so we're still facing labour shortages and delays across the industry. And then the third issue that we've got, builder insolvencies have led to delayed and cancelled projects in some areas, especially in the mid-tier development space. So look, KPMG estimate that by 2026 we'll be short around about 95,000 dwellings compared to the projected demand. So what does that mean for the market? It means that even if interest rates are high, which they're not forecast to stay high, we still have an underlying supply constraint that's likely to support prices, particularly in areas where demand is strong, like Southeast Queensland, Adelaide, parts of regional New South Wales and Victoria. For investors and upgraders, the environment makes property selection and timing even more important, especially if you're buying in areas where housing stock is very limited. So with all that in mind, the current performance, population growth, construction constraints, and the outlook for interest rates, what are the analysts expecting for the next couple of years? So the consensus view is that 2025 will be a modest year of modest growth, with momentum really picking up in 2026 as those interest rate cuts have sort of moved further along and housing sentiment improves. Now, KPMG, for example, is forecasting house prices to rise, to grow nationally by around about 3.3% this year, but picking up to 6% next year, 2026. So one thing that is interesting here, however, is that unit prices are tipped to grow faster than houses, largely due to affordability pressures in places like Sydney, Melbourne, and Brisbane. Now, at a city level, Perth and Brisbane do look stronger, and Adelaide is also expected to remain solid despite lower population growth. What's also worth noting is that regional markets are still expected to hold their ground, particularly where infrastructure investment and lifestyle migration are supporting demand. Now, of course, these forecasts are not guaranteed, but they do give a sense of the broad direction that the property market is likely to take. Now, that said, price growth isn't always the most important factor when you're making property decisions. Sometimes the opportunity to say, contribute, sale proceeds to super, sell the property in an income year where your tax might be lower, those sort of things can be more valuable than trying to pick the timing of the market. So these are the kind of conversations that we are continuing to have with our clients, because the right timing isn't just about the market, it's also about the right timing for your overall financial position as well. So those are the numbers there that we can see. So still some pretty strong growth next year. No sort of falls predicted for anywhere really across the capitals. Let's jump over and talk about rentals, because the rental market gives us a clear lens on where demand is actually strongest, especially in the short term. So over the last 12 months, nationally, rents have risen by 6.7%. Look, it's a little bit below the annual rate of rent growth from the peak, but still well above the long-term average. Vacancy rates are sitting at just 1.5% nationally. Compared to pre-COVID, the average was closer to 3.3%. So that's an incredibly tight market, especially in places like Perth, Adelaide, and parts of Southeast Queensland. There's vacancy rates there that are even lower than 1.5%. We've had a look at a few localities there where vacancy rates are down around about 0.5%, which is just putting incredible pressure on rents, upward pressure that is. All right, so as a result, we're seeing gross rental yields improving. Perth up around 6, Adelaide 4.8, Brisbane 4.5. they're the yields that you're getting. That's quite attractive for investors, particularly compared to where yields sat just a few years ago. Obviously, we can see that Sydney, the rental yield in Sydney is not particularly great. Now, looking ahead, rent growth is expected to slow slightly as some of the completions do catch up with demand, and population growth does ease a bit. Now, KPMG are forecasting rent increases of around about 3 to 4% per annum over the next 2 years. So whilst rental returns might not be climbing at the same pace as they did in 2023, 2024, the fundamentals still look strong, especially if you're in a market with ongoing supply constraints and high tenant demand. From a planning perspective, this rental strength creates more flexibility, whether it helps you actually service more borrowings to have a better quality of property, or if it leaves a bit of extra cash flow on the table to do things like super contributions as well. The other thing is that higher yields tend to lend to higher capital growth as well, because people are more inclined to invest in those areas. All right. One thing I want to touch on is the federal election just coming up, and housing policy is fairly sort of front and centre. We'll talk about Labor first, and we'll jump on to Liberals, really just focusing on the major parties. Now, Labor government has laid out a number of programs aimed at improving affordability and boosting supply. Now, the headline is the National Housing Accord, which commits to building 1.2 million new homes over 5 years, starting from mid-2024. Now, that is a big goal, and to be fair, it's the kind of supply side ambition that we do need. But the reality is we're already well off track. Latest forecasts suggest that we're going to fall about 200,000 homes short of that target, largely due to construction delays, planning issues, and labour shortages. So look, the intent is solid. The execution is proving to be the real challenge. Beyond that, there's also a $10 billion Housing Australia Future Fund, which is aiming to deliver around 30,000 social and affordable homes, and also a Help to Buy scheme, which is offering a shared equity model where the government takes up around or up to 40% of the home's value to help eligible buyers enter the market. In addition to that, Labor's also backing build-to-rent projects with tax concessions to encourage institutional investment, and they've also increased the rent assistance by 15% last year and another 10% this year to help ease rental stress. So, look, in summary, the plan is largely about boosting supply and helping lower-income households and renters. The idea's there, but as always, the challenge is how fast can it actually be delivered, especially in a market that's already under strain. All right, let's have a look at those of the housing policies being proposed by the Liberal Party. So their approach is focused more on incentivising individual buyers and reducing supply constraints through deregulation, rather than any large-scale government funding or construction programs. Now, one of the headline policies is to allow first home buyers to access their superannuation access their super to help with a house deposit. Now, look, on an individual level, that could sound appealing, especially to younger Australians who are struggling to get into the market. But look, at a macro level, it's a little bit more problematic. The core issue in housing right now is supply, not demand. We have too much demand, not enough supply. And policies like this one, where more money is being injected into the demand side of the equation, tends to push prices up, making housing actually less affordable overall. It also raises questions around long-term retirement incomes. Super really is designed to support you in later life, and accessing it early can leave a significant shortfall down the track if it's not carefully managed. But look, beyond that, the Libs are looking to expand the first home guarantee scheme, offering low deposit loans as little as 5% without the need for lenders' mortgage insurance. Now, that's for up to 50,000 people a year. Again, that aims to get more people into the market sooner. It's a demand side equation. It's attacking the demand side, which is already strong. It's not on the supply side. But they do have some supply side measures. So they are advocating for faster planning approvals and less red tape at the state and local government level, which is really a more direct response to the supply issue. However, advocating versus doing are two very different things when a lot of the control still actually sits with local governments and state governments. They've also expressed support for build-to-rent projects and further downsizer incentives to encourage better housing mobility across the age spectrum. So, look, overall, the Liberal platform's about empowering buyers and streamlining development, but it's worth noting without a serious and coordinated plan to increase housing supply, some of these demand-side measures, especially the super policy, actually risk doing more harm than good over the long term. All right, now, we're going to just jump into a few strategies here, which may or may not be relevant to you, but it's really things to think about as you're looking ahead. We'll touch over these ones just quickly. Really, the idea is just to sort of start thinking beyond just the property itself, but more so how it fits into your overall financial plan. And what I'd sort of suggest you do is if any one of these resonates with you or you think it might be applicable with you, please reach out to your wealth partner or get in touch with me after this, and we can definitely have a one-on-one chat about the applicability to you. All right, so we're going to quickly touch on a scenario that we come across often. We've got a couple in their early 40s. They've outgrown their former home. It's worth about $900,000. They have a $300,000 mortgage on the property, planning to keep it as an investment property because the way they see it, the rent covers the mortgage and they know they can sell it within 6 years to avoid paying capital gains tax thanks to the main residence exemption. On top of that, they're thinking, why bother selling, paying all those transaction costs to, maybe just go and buy another investment property, but there is a bigger picture here. So by holding onto the property, they're locking away over $500,000 in equity. That's something that might not even be a great investment over the long term. That property might not have been bought because of its investment prospects. It was bought as a home. Just because it's a good home doesn't make it a good investment. Now, if they sold the property, even after we account for 2.2% in real estate agent fees, they'd walk away with about $580,000 after paying off the mortgage. They could use that to go and pay off or reduce their non-home loan, then go and reborrow that for new investment purposes. Now, what that does is it creates a tax-deductible loan structure. So 6% interest rates that we have at the moment, assuming the couple's on a 39% tax bracket, they're going to end up saving about $13,500 in tax. So it means that they'd recoup all those entry and exit costs within a few years. But the other catch is a lot of people think that you can have multiple homes that you've had as former residences and claim the CGT exemption on them all. You can't do that. You can't have overlapping CGT exemption periods. So what happens is if they want to claim a capital gains tax exemption on the old home, they're going to end up paying capital gains tax on their new home, which is likely a more expensive property that's going to actually make more money. So they'd pay more tax in the long term. Add to that the fact that banks also assess borrowing capacity a lot more favourably when it's investment debt rather than homeowner debt. So for a lot of people where they feel like keeping the old home is a good investment, unlocking that equity, restructuring debt, being more effective can lead to far better financial outcomes. So, if you or anyone you know is actually thinking about keeping your old home or an old home as an investment property, definitely worth crunching the numbers on it first, because most of the time we crunch the numbers and look, it doesn't stack up. Going to have another one which is probably relevant for a few of you who I know are approaching retirement and starting to talk about when to sell your investment properties. I'm going to have a quick chat about why timing matters. At the moment, we're working with a 63-year-old couple. They both earn $120,000 a year. They've got an investment property that they paid $500,000 for. It's now worth $900,000. And then with retirement just around the corner, they're starting to think seriously about cash flow. Most people realise that property is great for capital growth. It's not so great in retirement because it doesn't tend to provide the income you need. So in this scenario, the plan is to sell the property, but the question is, should they sell it now while they're still working or wait until the first financial year after they retire? Now, if they sell the property today, there's $100,000 of taxable capital gain each. That's after applying the 50% capital gains tax discount. And because they're both still earning $120,000 a year from their employers, they've got to add the capital gain on top of their employer. And it means that in that scenario, they'll pay $40,700 in capital gains tax. But if they just wait a year until after they've stopped work, they can basically sell the property just with the capital gain as their only taxable income. In that scenario, they'd pay $24,600 in tax. So there's about a $26,000 tax, $16,000 tax saving in that one. It gets even better than that though, because they can also contribute additional money to super to bring the tax down, and we can get the tax down as low as $9,000 in that year. So there's about $23,000 worth of tax savings overall if we can actually get the timing right and sell the property after retirement and use superannuation contributions to help sort of reduce it. And just finally, something that some of you may not be aware of is the downsizer contribution. It's a strategy that doesn't get the attention it deserves, but just broadly, if you're 55 years or over, if you're selling a property that's been your main residence for at least 10 years, you can contribute up to $300,000 per person to super over and above the normal superannuation contribution caps. There's no work test, there's no limit on your super balance. So even if you've got $2 million in super, you can still make these contributions. So it's a great way of getting extra money into super if you are retiring and downsizing. Now, these sort of strategies, what I've gone over here is by no means a detailed breakdown that I expect anyone to be able to walk away and implement these strategies. It's really just bringing it to your attention. And if you're thinking about doing things, please have a chat with your wealth partner first so that they can take you through the opportunities or the consequences of it. All right, so to wrap things up, some of the key takeaways from today. Look, property, it's still the biggest driver of household wealth in Australia, but it's not one uniform market. We've seen how different cities, regions, and property types can perform very differently depending on local factors. Right now, the market is being shaped by tight supply, strong population growth, and a changing interest rate environment. So while 2025 is expected to deliver modest growth, many analysts are saying that 2026 will see stronger momentum, especially as rate cuts start to flow through. Government policy will play a role, but as we've seen, supply challenges really limit how quickly that policy can shift the dial. And more importantly, what you do with your own strategy matters far more than what the market does in a given year. So look, whether it's deciding whether to sell property, how to structure debt, how to make the most of opportunities like downsizer contributions and getting the right structure, those things can make a big difference. And look, finally, the best property decision is never about timing the market. It's about matching your decisions to your goals and making sure every part of your plan is working together. All right, now got time for Q&A. One question, so feel free to drop some questions in there. I've only got one question, which I'll jump into straight away, and that is around what is the impact of recent policy announcements out of the United States and what impact might that have on Australian housing? Look, at the end of the day, when share markets tend to get a bit volatile, we tend to find people have more confidence going towards the property market. We saw that in 2020. We saw it during the GFC. When there's a bit of volatility or uncertainty in share markets, people go, you know what, I want to take control of my super. We see more self-managed super funds getting set up, more people investing into property markets just due to comfort and familiarity. People understand property far better than most will understand share markets. So that comfort and familiarity tends to see more people go into property markets. Look, the other thing I think is if there is an economic slowdown triggered by the tariffs, wherever they end up landing, the prospect of more interest rate cuts is likely to increase borrowing capacity, increase demand for property, and have upward pressure. So really, I don't see any concerns around the property market coming from the recent volatility in markets and the drivers from that. If anything, I actually think there's going to be more people wanting to invest in property over equities as a result of it. Yeah. So based on there being no further questions, we'll wrap this one up. If there's anything that, or any questions that come to mind that you didn't want to put into the Q&A chat or anything you want to talk about, please just reach out to me directly or to your wealth partner. Happy to always jump on a call and talk to you individually about what it all means for you. So other than that, have a great afternoon, everyone. Thank you.